Are you worried about your investments during inflation? Let's delve into this a bit. Inflation, in simple terms, is the rate at which the general level of prices for goods and services is rising. Now, as these prices go up, every dollar you own buys a smaller percentage of a good or service. It's like being in a race where the finish line keeps moving further away. In other words, your purchasing power, the real tangible goods that money can buy, decreases. Imagine this. If a cup of coffee costs you $2 today during inflation, it might cost you $3 or even $4 for the same cup. So, in the grand scheme of things, your money is buying less and less. It's a bit like a silent thief, slowly eroding the value of your money. So how can you protect your investments during these turbulent economic times? Stay tuned as we explore this exciting journey together. Inflation can have a significant impact on your investments. Now, you might be wondering what that impact looks like. Let's dive in. Inflation, in its simplest terms, is the rate at which the general level of prices for goods and services is rising. Over time, as inflation increases, every dollar you own buys a smaller percentage of a good or a service. This is because the purchasing power of money, the bang you get for your buck, decreases as prices increase. So, how does this affect your investments? Well, the value of your investments can be eroded by inflation. For instance, if you invest $100 and earn a 5% return, you'll have $105 at the end of the year. But if inflation is at 2%, that $105 will only have the purchasing power of about $103. This erosion can be particularly harmful for those who have their money in cash or low-interest savings accounts. If your money isn't growing at a rate that outpaces inflation, you're essentially losing purchasing power. That's like going backward on a moving walkway. No matter how fast you walk, you're not making much progress. Now you might be thinking, okay, inflation can hurt my investments, but what can I do about it? There's no need to panic. While inflation can be a challenge, it's not an insurmountable one. There are ways to invest your money smartly during inflationary times. The key is to focus on investments that have the potential to outpace inflation. These might include stocks, real estate, or Treasury inflation-protected securities, also known as TIPS. We'll dive deeper into these options in the next scenes. Remember, the goal isn't to avoid inflation. It's a normal part of the economy. The goal is to understand how it works, how it impacts your investments, and how to make strategic decisions to keep your money growing. But don't worry. There are ways to invest your money smartly during inflation. One way to combat inflation is by investing in stocks. Now you might be wondering, why stocks? Well, stocks are often seen as a potent weapon in the fight against inflation. Over the long term, they have historically provided returns that outpace inflation. Let's break this down. Stocks represent ownership in a company. When you buy stocks, you essentially buy a piece of that company's future earnings. Now, in an inflationary environment, many companies can pass on their increased costs to consumers in the form of higher prices. This can lead to increased revenue and subsequently, higher profits. As a stockholder, when a company's profits rise, the value of your stocks may also increase. This is why stocks can serve as a hedge against inflation. However, it's important to note that not all stocks fare well during inflation. Companies with strong pricing power, that is, the ability to increase prices without losing customers, tend to do better. These may include firms in sectors like technology, healthcare, and consumer staples. Conversely, companies with low pricing power may struggle. Moreover, the stock market can be volatile, and investing in it involves risk. It's not a guaranteed way to beat inflation. It's crucial to diversify your investment portfolio and not put all your eggs in one basket. Having a mix of different types of investments can help spread out risk. Remember, investing in stocks requires research and understanding. It's not just about picking a company because you like its products or services. It involves analyzing the company's financial health, growth prospects, and how it's managed. It's also about keeping an eye on the broader economic and market trends. In conclusion, stocks can offer a way to potentially earn returns that beat inflation. They can be a part of your investment strategy to preserve and grow your wealth during inflationary times. However, they should be considered as part of a diversified investment portfolio. So stocks can be a good investment during inflation, but they're not the only option. Real estate can also be an effective hedge against inflation. Now you might be wondering, how so? Well, the value of real estate often rises with inflation. This means that if you invest in a property today, it's quite probable that its worth will increase over time, especially during periods of inflation. So you see, when the cost of everything else is rising, your real estate investment might just be keeping pace or even outpacing inflation. Let's delve a little deeper. Real estate is a tangible asset. It's something you can touch, see, and use. This physical nature of real estate contributes to its ability to maintain value during inflationary times. When prices are rising everywhere else, the demand for real estate usually goes up, pushing up its value as well. And here's another interesting point to note. Real estate is not just about buying and selling properties. There's also the potential for rental income. If you own a property and rent it out, you have a steady stream of income, and guess what? This rental income can increase with inflation. As the cost of living goes up, so does the rent you can charge. This means your income from your real estate investment can keep up with or even surpass the rate of inflation. But, like any investment, real estate is not without its risks. It requires a significant upfront investment, and there's always the possibility of property values declining or rental income dropping. Despite these potential drawbacks, the long-term benefits of investing in real estate during inflation can be substantial. So, to sum it up, real estate can be a valuable tool in your investment arsenal during inflation. It offers the potential for capital appreciation and increased rental income, both of which can help offset the effects of rising prices. But there's still one more investment option that you should consider during inflation. Treasury inflation-protected securities, or TIPS, are specifically designed to protect against inflation. These are a type of U.S. Treasury bond, a government-backed security that is indexed to inflation. But what does that mean exactly? Well, to put it simply, the principal value of TIPS increases with inflation. So, when you buy TIPS, you're essentially buying a promise from the U.S. government that the value of your investment will grow at the same rate as the Consumer Price Index, a common measure of inflation. This means that if inflation roars, the value of your TIPS will too. Now let's talk about the interest on these securities. TIPS pay interest twice a year at a fixed rate. This rate doesn't change over time, but what does change is the amount you receive. Why? Because the amount of interest you get is based on the adjusted principal, not the original amount you invested. So, if inflation has increased the principal of your TIPS, the interest payments you receive will also increase. This is why TIPS can be a great tool for investors who want to maintain a steady stream of income, even during inflationary periods. They offer a way to preserve the purchasing power of your money, despite the rising cost of goods and services. But like all investments, TIPS are not without risks. The main risk with TIPS is deflation, a decrease in the general price level of goods and services. If deflation occurs, the principal of your TIPS could decrease, and so would your interest payments. Moreover, while TIPS can help you keep pace with inflation, they may not provide the same potential for growth as other investments like stocks or real estate. Therefore, they are often used as part of a diversified investment portfolio rather than a standalone investment. So, TIPS can be a safe and effective way to protect your investments from inflation. However, as with any financial decision, it's important to consider your own risk tolerance, financial goals, and overall investment strategy before diving in. Let's quickly recap what we've learned today. We started off by understanding inflation, which is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. We then delved into how inflation impacts investments. Essentially, it erodes the value of money, which means you must earn a return on your investments that outpaces inflation to increase or even maintain your purchasing power. We explored 3 best investment options during inflation: stocks, real estate, and treasury inflation-protected securities, or TIPS. Stocks, though they can be volatile, have historically provided returns that beat inflation. Real estate can act as a reliable hedge against inflation, as property values and the income from rental properties tend to increase with inflation. And TIPS, they adjust with inflation, ensuring your investment keeps pace with the rising cost of living. Remember, while inflation can be challenging, with the right investment strategy, you can navigate these turbulent economic times successfully.